A company that Apple publicly abandoned 6 years ago surged 15% in a single session Friday, hitting a gain of more than 500% over the past 12 months, and it happened on the same day the 30-year Treasury yield closed at 5.13%, its highest level since June 2007. Those two facts should not coexist easily. When long-duration bond yields spike to near-generational highs, risk assets compress. Yet Intel, a stock that has spent years being written off as a relic as an older chip era, moved in the opposite direction and moved hard. The broader session reflected the yield pressure. The S&P 500 pulled back, tech stocks sold off, NVIDIA slid 4%, AMD fell alongside it, and gold dropped on rising hawkish Federal Reserve expectations. Traders in the Fed funds futures market now price in a roughly 51% probability of a Fed rate hike by December, the first time this cycle that a hike, not a cut, is the base case for year-end. Consumer prices rose 3.8% annually in April, wholesale prices rose 6%, and Trump returned from Beijing without a concrete agreement to reopen the Strait of Hormuz, keeping oil elevated and inflation expectations unanchored. The macro backdrop was unambiguously hostile to long-duration technology bets. Inside that same session, Cerberus Systems, which had debuted Thursday at 185 and surged 68% to close at 311, slid roughly 10% on Friday as early IPO buyers took profits, a reminder that AI enthusiasm does not run in a single direction. SpaceX accelerated its IPO timeline, now targeting a June 11 NASDAQ pricing at a valuation that sources put near $1.25 trillion, the largest public offering in history. The AI and space capital deployment pipeline is enormous, but Intel's move was not about that pipeline. It was about something the market had quietly decided was already settled.
In 2020, Apple announced it was leaving Intel's processors entirely and moving to its own M-series silicon, a decision that removed Apple as a customer, accelerated Intel's revenue decline, and became a symbol of the company's strategic irrelevance in a world where the biggest consumer hardware maker had concluded it no longer needed outside chip suppliers. The market priced that conclusion in for years. Intel's stock reflected it. The Foundry business Intel built in response, a bet that it could manufacture chips for other companies the way TSMC does, was treated with consistent skepticism about execution timelines, yield rates, and whether any marquee customer would actually commit. A preliminary manufacturing agreement with Apple changes that skepticism by attacking its premise directly. Apple does not enter chip supply relationships casually. Its supply chain decisions involve years of qualification testing, and the company has demonstrated it can and will build its own silicon when outside partners fall short. An Apple-Foundry relationship would mean Intel's manufacturing quality is approaching the threshold Apple requires, a threshold that, if confirmed, resolves the core question the investment thesis has depended on. The 15% single-session move reflected not just the news, but the re-rating of what Intel's Foundry margins could look like at scale if a customer of Apple's volume and engineering discipline becomes a reference anchor. That re-rating carries a condition embedded within it. The word preliminary is doing significant work in the reporting. Apple has qualified chips with outside foundries before without the relationship surviving to production scale. TSMC's position as Apple's primary manufacturer was itself earned through years of delivery at volume. A preliminary agreement signals interest, not commitment. Intel's stock is now pricing something closer to the latter. The gap between those two states is where the next move in INTC lives, and the 30-year Treasury yield at 5.13% means the cost of being wrong about that gap has risen materially.
The unresolved question from the Apple news is not whether Intel can manufacture chips. It is whether Intel can manufacture Apple-grade chips at the yield rates and delivery timelines Apple's product cycle demands. That distinction matters because Intel's recent enthusiasm has stacked several sources of repricing simultaneously. Optimism around NVIDIA's Rubin platform using Intel Foundry capacity, Google Xeon deployments, and now the Apple signal. Each of those is real, that they are sequential bets on a manufacturing capability whose proof at scale remains ahead, not behind, the current valuation. The historical parallel worth examining is TSMC's own foundry emergence in the late 1990s, when skeptics argued that a dedicated chip manufacturer without its own designs could not attract enough marquee customers to justify the capital expenditure required. TSMC's answer was a succession of reference customers, each one lowering the perceived risk for the next. Intel's foundry strategy follows the same logic, but with a critical difference. TSMC built its reputation from a clean sheet, while Intel is building its foundry credibility on top of a manufacturing infrastructure that spent years missing its own process nodes. Apple, if it does commit at volume, would be Intel's TSMC moment, the reference customer that resets the prior narrative. If the agreement does not progress to production, the re-rating reverses at speed. The verification benchmark is the SpaceX IPO window. SpaceX's accelerated June 11 pricing will test whether the capital markets can absorb a $1.25 trillion offering alongside rising bond yields. If that IPO prices cleanly and trades well, risk appetite and technology remains intact, and Intel's repricing holds its ground. If the bond market continues its current trajectory, with the 30-year holding above 5% into that window, the discount rate applied to Intel's long-duration Foundry earnings estimate rises with it, compressing the multiple on exactly the future revenue the Apple relationship would represent. A Fed rate hike by December, now the marginal bet in futures markets, where it stemmed that compression further. Intel's 500% year in that scenario was the easy part. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.